I'm just a dude in a tank top with pretty muscles and an opinion, but I got something to say, and that's all I got to say. Everywhere you look right now, there's talk of a market crash. People and so-called experts are pointing at PE ratios, cash on the sidelines, recession fears. But here's the truth. Recessions are historically hard to pick, and most people are missing the nuance. We already had a stealth crash. Look beneath the surface. Outside of the Mag 7, sectors got crushed over the last 2 years. The only reason the index didn't look like it was in free fall is because a handful of mega caps, Nvidia, Apple, Microsoft, Tesla, and the rest, were carrying the weight. That's why pointing to the S&P's headline PE ratio as a bubble signal is misleading. Strip out the Mag 7 and a couple others, and the S&P 490's PE reverts right back to historical norms. The so-called overvaluation is narrow, not broad. Then there's Berkshire. People look at their $300 billion in cash and call it a signal of fear. But if you understand the game, you see it for what it is, a defensive but smart reallocation. The Fed raised rates at the fastest pace in history, so why wouldn't Buffett park billions in treasuries for a risk-free return? That isn't a bet on an imminent crash. It's disciplined capital allocation in a rate environment that rewards patience. And the price-to-book argument, it holds even less weight today. The dominant players now, software, AI, platform giants, are asset-light and intangible heavy. Their real value is in IP, networks, and brand, things book value doesn't capture. That's why PB looks inflated. It's not a bubble metric anymore. It's a reflection of how the economy has evolved. What I've learned is the market is a game and the rules are written by monetary policy. Reading Lords of Easy Money made that crystal clear for me. Once you see the Fed's playbook, you realize the big moves come not from guessing quarterly earnings, but from tracking liquidity cycles. And right now, we're on the verge of a shift. Everyone is positioned for recession. Cash parked in treasuries, analysts pointing to stretch multiples, but few are positioned for the acceleration that happens when easy money returns. And make no mistake, we are moving toward another easing cycle. So the story isn't, are we on the verge of a crash? The stealth crash already happened. The bigger story is that while most investors are hedged for contraction, almost no one is positioned for acceleration. The market's next move won't be about fear. It'll be about liquidity. The game is changing again, and the ones who understand who writes the rules will be ready. But hey, I'm just a dude in a tank top with pretty muscles and an opinion. That's all I have to say about that.